to the 50th episode of Value Creation in Life Sciences. So I wanted this 50th episode to be special, and I'm happy to have you here. So maybe we start with a small introduction.
Yeah, hi Saurabh. Thank you for inviting me. It's great to be here. So let me tell you a little bit about Hadean Ventures. It's a European life science venture capital firm. We have our headquarters in Oslo, a Stockholm office, and also footprint across Europe. We have 2 funds under management. Our first fund was approximately 85 million euros, and we have a second fund now of 144 million euros, which was launched in 2021, so already a couple of years old now. Mm-hmm. We are investing across the life science space, pharma, biotech, medtech, diagnostics, and digital health, across Europe, with a focus on areas of Europe that we find underventured, in particular the Nordics and German-speaking Europe. But as I said, we do invest across all of Europe.
Perfect, super. So I would like to start this interview with, in 2021, late 2021-22, biotech market crashed, right? And it did have a repercussion on many of the biotech companies. Many biotech companies survived, many did not, as you already know. I want to understand basically the psychology of investing, during that particular time. My first question to you is that during this past 1 year, did your investment psychology change after the crash or before the crash? What I mean by that is, were you fearful when you're trying to invest in new assets during the crash, after the crash happened, or you were as good as you were before?
Mm-hmm. So I think we've always been a little bit fearful. It's a risky sector, and as I mentioned previously, we focused on areas that are sort of underventured, which means that the areas we invest into have traditionally had low levels of venture capital available. So this lack of venture capital has meant that since we launched our first fund, have approached investing conservative and carefully when it comes to planning for longer term financing. We also had sort of a conservative approach, and since I feel we've been less under pressure in terms of competition from other VC investors, the valuation levels have been pretty conservative that we've invested in. So I feel that we somewhat were quite prepared when the crash came. Obviously, it was not something that anyone could have predicted when a crash like that would come. But we already sort of had the attitude of, let's not invest at high valuations, and let's plan carefully for financing rounds in the future. And that's really sort of the attitude you needed when the crash came. So in a way, I felt that we were quite prepared, which means that after the crash, if you will, our approach and strategy hasn't really changed that much. Mm-hmm. I think we have, like many of our peers, have sort of taken a step back and sort of, especially at the beginning, wanted to observe what was going on and see where things were going. And since then, things have been business as usual.
Perfect. So I'm not sure if you have heard the name of Michael Burry, who was, let's say, a hedge fund investor, and he's a contrarian investor basically, and he gained a lot of popularity in 2008, where he shorted S&P 500 and so on. And he, I think in this movie, The Big Short, he is also shown a big. So he has again shorted S&P 500 today, okay, and expecting that the S&P 500 would crash because there could be many arguments for, and nobody can say whether he is right or not. That he was right earlier doesn't mean that he might be right. But let's say the market drawdown also has not been, let's say, it's been kind of consistent because of the interventions of federal government and so on, right? So there might be a crash. So let's say, for example, if his prediction is right, okay, and S&P 500 crash happens, there will be again a kind of a repercussion across all public listed stocks and so on. And there is always, and despite being a private equity, there is, of course, a kind of a indirect relation to it, right? So how do you prepare this? Let's say one crash has already happened, or do you think that anything will be changed because of if S&P 500 crashes again?
So I think that for us, IPOing a company is another venue for further financing, taking the company further, potential longer term, an exit, selling down, when the time is right into a company. That venue has not really been an option for us since the first crash. I think we are all sort of looking forward to the day the IPO window is there again, but nobody can plan for when that happens. But actually it means that, if we have another crash or the downturn continues, it's basically a continuation of what we're seeing now already, and that we have adjusted for in our investing. So it wouldn't be good for anybody, but at the same time we are in this situation already where we are dealing with our private companies and investing in a conservative way. And obviously from a life science perspective, the real valuation happens when you can show that you have good data from your clinical trials, right? And that is very company specific and internally driven. And that company will be attractive from an acquisition perspective. And the situation today is that the big pharma companies do have a lot of cash available and are in acquisition mode. And that is independent from what happens on the market.
Correct. Perfect. So let me ask you a question very related to this. As you talked about pharmaceutical companies having cash, we cannot predict many things in the future, but at least we can say many things that what are the things that are not going to change. So what I mean by that is there was a very interesting question asked to Jeff Bezos, and about what he thinks about the future of Amazon and so on. And he gave a very interesting answer that, okay, I cannot talk about what's going to change, but there are a few things which is not going to change. And one thing is that our customers will always want a lower price. So that is not going to change. So I was just thinking out loud in terms of what are the things you think is not going to change from both biotech and pharmaceutical perspective in the future? I mean to say, think about it. Today, right now, RNA is hot, because of the vaccines, and everybody, the valuations are relatively higher and all that. But you also know that, maybe in the future, there might be another technology that might come and that might go down and go up and all that. So it's very hard to predict that, right? But what are the things you think that is not going to change in this life sciences space, and for which you can make a strategy on that?
Yeah, very fundamentally, there are, modern medicine has made huge progress, but there are still huge unmet medical needs. There are so many medical challenges that still need to be tackled. So there's plenty of opportunities for innovation to improve lives for patients. So that's going to continue. And the other thing, obviously, that will not change is patent life coming to an end for the big pharma companies and patent cliffs, and the need for innovation to refill their pipelines and their bags of products. So that's going to continue, and that's a driver for our business.
So regarding your argument on patent, let's say, I'm sure you might have analyzed the effect of your investment because of Inflation Reduction Act. Does it bother you that your prices could be negotiated, and that might in turn affect the value of the asset, leading to a lower deal values of the pharmaceutical companies, because pharmaceutical companies will not see that asset as a, let's say, very interesting compared to earlier, because right now you'll be under Inflation Reduction Act?
So our approach has always been to value the future revenues of the products we invest into on a conservative basis. And we know the challenges of the healthcare systems. We need to make healthcare more sustainable, which means that the pricing of the products in the future need to account for that. So we have always tried to take a conservative approach when we look at what we believe the pricing is going to be in the future for the products we invest into. So it's a continuation of that, really, because as I said, healthcare is the healthcare costs are not going to go down by themselves. We have a future with an aging population and more medical need, and we need to create healthcare systems that can deal with that. So we need sustainability also in our chain.
Got it. Super. So you talked about an introduction about Hadean Ventures, and I see that you are investing in a broad spectrum, like not only just therapeutic area, but let's say diagnostics, medical devices, and so on. So I have a curious question, because in general, the VCs like to rely on power law returns, where they invest in, let's say 10, 6 or 7 or 8 might fail, and 1 or 2 brings them a huge, and that happens when you invest, let's say, only in therapeutics, for example. When you invest in medical devices and diagnostics, for example, the returns may not be as huge as, let's say, in therapeutic class. So what is your strategy, let's say, in terms of course, I'm not your LP, so I'm not asking on that respect, but at least trying to understand the strategy of Hadean in comparison to other VCs that focus only on the therapeutic class. Is it like, you'd like to not focus on extremes rather than you want to have a balanced return? Because one option is always that, you aim for a very high return. And another option is that if the market, let's say, if market is making 8%, one option is to make 20% based on taking very high risk. And one option also is to take 8%, but at a reduced level of risk. This is not talked about, actually. So what is your thought process on why you want to invest across all, not only just on therapeutics?
Yeah, you're absolutely right. We do invest across different technology areas, and we do have a bias towards therapeutics. So our portfolio is overweight on therapeutics, but we do also like the diversification on the risk side by also investing into medtech, diagnostics, and also digital health. Also, we come from a background where the team has experience in that space. We are comfortable investing in it. So it's for us, it's a combination of both having the background and the skill and experience investing in that area, and also liking sort of the diversification across different technologies, where we do, as mentioned, have sort of overweight on the therapeutic side, but they're also diversify into companies with a different risk profile, as you mentioned.
Got it. So let's talk a little bit about ambition, and I'm going to give you an analogy about, let's say, if you take an example of Tesla, right, or space, where Elon is. So you could rate it as a very high ambitious project. Okay, of course, not many are into that high risk, high ambition project. When you analyze many biotech, let's say, companies or medtech companies, do you see that, or it could be also let's split into two. Do you see that there is a lack of ambition in life sciences CEOs because of its huge capital intensive nature, where they just want a small amount of money and then they want to license out and go? Or if yes, then what is the constraint that's putting them? And if no, then can you share me the examples of some of the companies where you see that the CEOs are very highly ambitious to take that unmet need to another level, no matter how capital intensive it is?
Yeah. Were you sort of talking about European CEOs right now, or?
Yeah, exactly.
Yeah, no, there's a difference in approach there. I think it very much depends from person to person. So I do, agree. I think US has traditionally had much better access to capital. So sort of the ambition level or sort of the plans have been according to that. And in Europe, the capital has been much more constrained. And the CEOs and the companies here have, had to adjust for reality. I don't think it's necessarily only a bad thing. I think some capital constraint is good. So the golden middle is good. You don't want too little because you're not able to run the right experiments, get the right people, etc. At the same time, it can definitely be too much capital as well, which makes it hard to generate the right returns. So from our perspective, finding the golden middle where you have the right ambition level, you can do the right things, you can hire the right people, run the right trials, and also get the right return on the capital is sort of the way to go.
So do you also, let's say, in addition to the capital constraint, do you also think that, taking risk is also depends on the cultures, right? So let's say in US American culture versus European culture, the mindset, do you think that also plays a role where, because here also there are exceptions, like for example, Argenex, I could rate at one of the exceptional companies that as a European CEO, he has been taken the company to a very high, let's say, with a successful myasthenia gravis product as well in the market. But do you see that culture also playing a role in this mindset?
Yeah, absolutely. And I think, yes, we could probably use a little bit at a higher ambition level, risk willingness in Europe to some degree. But I think it's one is culture, one is just reflective of the situation. I think you kind of have to be ambitious at the same time, adjust for reality as well to make things happen. Absolutely.
Agreed. So in terms of when you analyze any deal, right, what is the trigger point that leads you to decide that, no, this is not an interesting investment because of the team, for example, because it's very hard. I mean to say, I always tell to many, it's very easy to have a drink with somebody, but it's very hard when you start working and then you realize that whether he is a good partner or not, right? Now, when you're trying to analyze an investment, it's like a marriage, right? You're trying to invest in a team where their thought processes and your thought process are aligned or not. So what are the trigger points you use to differentiate a very good company because of the team versus an average company because of the team?
So obviously, as we all know, it's developing a drug is an extremely complex process, right? Where you need a number of different skills and expertise. And ideally, when you start looking at investment opportunity company, the company already has that team in place. That's going to be, we like the asset, we like the data they have, and they have sort of the team in place already. That's sort of the perfect situation that we're looking for. However, that's usually or very often not the case. And basically what we try to look for then is, the founders, the people running the company right now, are we on the same page when it comes to, expanding the team going forward, getting the expertise and the people that are not there today. And it's more about, what are the strengths of the current team? How can they be leveraged going forward in the future in the company, at the same time filling those gaps that are not there in the company, right? Just finding the right people to make the best out of the development. So it's more about identifying the strengths and weaknesses and preparing for getting the expertise into the team that's not there today.
Got it. So while analyzing this, as you know, we are human and we make mistakes. Has it happened any time that you rejected a deal and then later you realize that, no, I should have invested because, whatever reason, it got a very good exit? I know exit is very hard to define in a biotech because, first of all, it takes a lot of time. And second, A successful exit could be a nice deal value by a big pharmaceutical company. But the question is that, what did you reflect on those decisions if that happened? If it hasn't happened yet, then it's okay,
Yeah, no, I think that can obviously happen. It's good to reflect on those. At the same time, there are decisions and their outcomes, and there are good and bad ones, right? If you have sort of a good decision with bad or the wrong outcome, it could still have been the right decision.
Correct. Yeah.
So that's sort of going back and reflecting, was this a good or bad decision? Whether the outcome was what we expected or hoped for or not. So I don't think, if we go back and say, we did our work, we did a proper analysis, and for these very good reasons, we decided not to do this deal. That's just how it is. If something else happened, then we don't beat ourselves up out of it. For us, it's the most important thing is to do our work properly, do our analysis properly, and have good decisions. And then we think overall the right outcomes will come in the long term.
Absolutely. And there could be a possibility that, you made everything perfect, but biotech is such a sector that, there are many things which you cannot control, actually.
That's how it is. Yeah.
So, yeah. A question related to that is, how do you define, or let's say, how do you envisage scaling a biotech company? Because in tech, it's simply different, it's faster, you scale up, you get more subscriber and so on. It doesn't work this way in biotech. So let's say when you are putting an investment in a company, and you always have a vision, right? Okay, I think the company can become this much, but to scale that company, there are many elements required. So what are your thought process on scaling a company? How can the biotech company scale well?
Yeah, usually they have sort of the pipeline they need to develop. They have the development plan. So we have an outline already when we invest, and then it's about ideally when we invest, we have sort of laid out the financing, tranche-wise financing based on milestones. And then the scaling comes, when they hit the right milestones, get the financing based on that, and also manage to scale the team. Hopefully as we talked about earlier, get the right people with the right expertise to come and support the company. That's sort of what we look for when we work with a company.
Got it. So as we're talking about, the decision and the outcomes, right? So that means that we also focus on skill and luck, right? So in the sense that there are many times luck is something which we cannot control. And I can give you several examples without naming the pharmaceutical companies where the two deals were done because the CEO of this small biotech, or let's say mid-sized biotech, was a school friend of head of licensing and BD of XYZ. And it's a true story, I'm not saying that all deals happen like that, but the point what I'm trying to make is that it's hard to control these kind of things, right? So what would be your advice, and I think, there are many ways this is described by many people. Many people talk about, they call it luck surface area. To how do you increase the luck surface area by, let's say, for example, if I have to get business, I cannot get business sitting in the office, right? I have to go out, I have to meet people, I have to present, in the congresses and so on, right? So, that increases the probability of, getting successful. So, so there is one thing called skill, which of course you need to kind of scale the company and so on. But there is also something, how you increase the probability of a success, or you increase the luck surface area. So what would be your couple of points to biotech companies or CEOs that they can leverage on to increase the probability of being successful?
Yeah, so from our perspective, there are really sort of two main ways that we increase the probability of investment being successful, or sort of to manage risk. Is first of all, when we analyze a new opportunity, we really go deep into the data and try to see that we understand what is a pathomechanism, what is a mechanism of action. Do we really understand what's happening here? the animal data that they have, the models they've used, have they been, are they successful animal models? What sort of the probability of those converting into human data? So we look at all of these things to really try to understand the opportunity, or to try to avoid these sort of black box situations where there is, perhaps good animal data, but we don't really understand why. We don't really understand the mechanism. We try to avoid that. We really like to understand what's going on. So that's one way of increasing the probability of a chance being of a product being successful in clinical development. And the other thing that is sort of nurturing and supporting the company during this development, and for that obviously you need a skillful team with, as we talked about a few times right now, the right expertise. And getting those people, because there are so many pitfalls during this development, avoidable pitfalls, that if you have the right people in place, you can avoid them, right? So we really try to make sure that we have the right people in place to do the right things. When we invest into a company by a founder, these are often, particularly new founders, when they've started a company for the first time, these are typically very smart people, and going forward they learn very quickly. However, if they haven't done it before, we prefer they are supported by people who have done these things before, so that we don't have to invest in sort of the trial and error period of somebody learning to do this for the first time. That's always more expensive and takes longer. So we try to get that expertise in, so we can hopefully do it right the first time.
Correct. So, so as you invest in very high uncertain environment, would you agree that higher uncertainty also implies easier decision making?
No. That's the short answer. I definitely don't think it's easy decision making. In fact, very, very hard decision making. And with us, it's teamwork. It's team-based work. And when we make a new investment, it's basically after numerous rounds in our team, in our investment committee, in our full team, and we really like to get the perspective of everyone. We have a lot of smart people working on our team, and it's really sort of trying to think about every angle when we're making a decision. So it's a long and thorough process, and I would not say it's easy, but it's a good process.
So the reason I asked you is easy is that when you manage your portfolio, right? So there is it's mathematically difference between X and FX, right? Where X could be, let's say, your investment in several companies, and FX is your returns. So the more uncertain or more volatility is there in the environment, then more the X and FX kind of separates actually. So the whole idea is that maybe if mathematically, if you're convex, like Jensen's equality, for example, and the way you could be convex, I'm just thinking out loud, is to, of course, not put a big portion of chunk of your investment in one particular asset, rather, fail fast, fail cheap, that kind of mentality, So I was not asking this easy I was not saying easy in that respect, literal sense. Of course, it's not easy, it's a complex, but in a conceptual framework, whether, you have, because the point conceptual framework was this: if everybody knows all the information, right, it's very hard to make money, right? And you're investing in an uncertain environment. So, as a professional VC, I think, there has to be some attributes that would give you better return than the market, otherwise, that was the whole idea, So I hope, you can say that, yes, it's not that easy, but yes, comparatively, you are at an advantageous position in comparison to others in making investments, right? That was the point.
I definitely think we have an edge. I definitely think we have an edge, and obviously we are investing into private companies, we can dig very deep, and we have a freedom to ask about, all the questions we have and get all the information we need, and have our team analyze that. That's definitely an advantage. So that's definitely a difference from, as you said, referring to public markets.
Exactly. In fact, I remember I had one discussion with one of the partners in another VC firm, and I asked him, "What's your advantage in comparison to other investors?" And he gave a very interesting answer. He said, "We have inside information, right? Because you cannot afford to have inside information when you're a publicly listed company." Cool, perfect. So I think we are almost half an hour. Maybe one last question. So it's about men and women in decision making. Okay. Based on several research, it's said that men more likely than women make extreme choices, right? And it's because mainly could be based on evolutionary biology and societal norms. Have you seen that? One thing is research I read. One thing I wanted to get it from the real world people. Have you seen that mindset either in your team where you were more conservative, whereas your men were like taking extreme choices, in making an investment, and also in the portfolio companies, where you had women CEOs, if you had, or men CEOs?
Yeah, I think sort of when you look at a large number of men and women, I think sort of the understanding is that women are more risk averse. That's probably right when it comes to the larger numbers, but in sort of the small numbers we are on the team, I think it's very individual based. So based on from person to person, how risk averse they are, or risky, how much risk they like to take. So in the team, because we have a very sort of gender balanced team, so in the team it's very much person based, I would say. But I really appreciate the diversity in general that we have, not only when it comes to gender, but it comes to background, nationalities, cultural background, universities they studied at, the subjects they studied, and that's extremely valuable, having sort of diverse thinking around the different problems that we're facing. So that's something we like to sort of get together in our team and also leverage when we have our discussions. So we like everybody to participate and hear everybody's thoughts around this, because as I said, we have a lot of smart people on our team.
Absolutely. So to kind of conclude, you do not see any variations in decision making or a difference in decision making psychologically when it comes to men and women making extreme choices. It's like, depending on very individuals, right?
Yeah, absolutely. I definitely see variations, but I wouldn't sort of attribute it to gender in the small sample.
So for example, if you talk about driving, I could, when I read this, I could easily relate to driving, because men are rash, drivers, they create more accidents, so they're ready to take more speed and thrill, in comparison to women, So I thought maybe in investment also it could be like that.
Yeah, I know. As I think probably, as you said, when it comes to sort of larger data, that it probably could show something like that in listing as well.
Super, perfect. Ingrid, thanks a lot for your time, and I'm so happy and glad to see you. At least we didn't have a chance to meet face to face, but at least here on Zoom. And thank you for gracing this occasion on our 50th episode. Thank you very much.
Thank you. Great speaking with you.